Hello traders, Gary Wagner here, just before 10 o'clock in Honolulu, 4 o'clock in New York on Tuesday, the 10th day of March, 2015, and this is the daily report for gold and silver. What a day we're witnessing in the market with dramatic sell-off in the equities markets. Oil is trading lower. The precious metals markets are trading lower, and it's all about the dollar going to a 12-year high. Let's first look at gold. Currently trading off about $6-7 on the day, 1160.71. Its current print. It's off of a low of 55.50, 1155.50, a high of 69.80. And as I said, currently trading off about $6-7 on the day. A couple of things we will be discussing is strategy. I'll send out a special trade alert to clarify it, but a strategy for entering the market should we see a break below what we're labeling at around 58, 57 in that area. And if we see a strong break, we do want to enter this market from the short side. We'll talk about that in a moment. And then the second thing I want to talk about is tomorrow we will be doing a live webinar at 4:30 Eastern Standard Time. Hope to see you then. Silver also trading lower on the day, off about 9-10 cents. As you can see, our current print is 1567. It has had a low of 1559 and a high of 1581. We'll touch on silver in a little bit. There's absolutely no doubt. We are seeing tremendous activity in the market. Gold currently trading, as I said, roughly at 1160. And if we take a look at the equities markets, this is a half-a-day chart, Standard & Poor's, the E-mini contract. We noticed the fact that one thing that we could see is every time we began to see these rounded tops, we got a pretty sizable correction in the market. We got one here. We also got one here. We noticed this a couple of days ago as we started to get that rounding top, and we certainly got a sell-off. If you can see, right now the market's trading roughly at 2045, and it puts it just below a 23% retracement, which is 2046. If the market does not find support in this area, my sense is that the next logical point for the market to go would be this 38% retracement level, which comes in just above 2000. That would be a considerable drop in the market. But traders, we've seen that kind of drop before, as we saw right in here. So it is certainly possible, but let's see if we can find any kind of support in this area. If not, as I said, that's our next logical step in terms of a more interim term basis. And traders, talk about volatility. We are looking at a daily chart of the volatility index, the VIX, and there's absolutely no doubt. You can see it around here at 13. At the beginning of the month, it's already up around 16. So we're getting some fairly strong volatility re-entering the market. Now, the reason that many are citing for these volatile moves has been the dollar, and you'll see when we take a look at the chart that the dollar has just been skyrocketing higher and higher. And traders, this is just what we're talking about. This, of course, is our dollar index. It's now sitting close to 99, 98.63 on our chart. This is a two-day chart. Reason for using 2 days was to simply be able to move more candles into the chart surface itself, or the chart area, I should say, itself. But we've got this runaway market, and whether we look at a 2-day or simply a daily, you can see that this market has just been almost a straight linear move up really since the beginning of this year. Of course, this entire trend really began July of last year. Right in here, it had been trading fairly sideways, roughly at around 79 in that area in terms of the index. It accelerated, small retracement, accelerated. We had a congestion area. We had this other congestion area right in here, and as we pointed out, I believe that it had to do technically with this particular 50% retracement, and that's a 50% retracement of a very large range in the dollar, but we've now broke substantially above that. And that, of course, has put pressure on the equities markets. It's also put pressure on gold. So traders, how does this tremendously strong dollar really relate to gold? And I think that it is incredibly important to note what we're seeing today. When you look at the strength of the dollar and then look at the current level of gold, as I said, it's currently trading off right now roughly about $6. Of that $6, gold is actually, due to normal trading, is actually trading up about $5.30. It has gained in value. Although, when you take into account a strengthening U.S. dollar, that decreases the value of about $11.10 per ounce. So the net change off $6 really reflects a salmon swimming upstream because gold is up, but the dollar is more than compensating for any kind of gains and actually not only taking away those gains, but more importantly, throwing it into negative territory, which brings me to our strategy. Now, yesterday, we saw the market break to 55, and at 55, it found support. That's this low right in here. And we can easily see some recent lows. The most important one is really 61 right here, and that's really where the market is at right now, is 61, because that matches up with this current low. We have one low below that, and that is the low of 1130, the beginning of the rally in November. So we're absolutely at a crossroads, and that's what has kept us sidelined, because I'm looking for the market to have either a strong bounce to the upside or a break to the downside, but in this particular area, we are right at this level of support here. It appears as though, at least on a tentative basis, that we could be experiencing the 61 area as resistance. Now, that being said, if that's the case, and 61 becomes resistance and we break below this again, then my recommendation is once we break below 55, so to speak, that's the existing low in the market, right as of yesterday, if we break that, you can enter the market from the short side, placing stops above 1162. So 1162 in terms of stop placement, you want to enter the market on a break, and a break below 58, 56, especially if it breaks to 55 and below, you want to be in there from the short side. Protective stops again at 1161. If by some slim chance we get a bounce in the market to the upside, I would not take that call. I would not take that call unless we broke above really 75, which is that 76% retracement level. In other words, I need to see a sizable bounce to the upside or a follow through in the breakout to the downside. We definitely have the direction of this market is absolutely down. When you look at the MACD, that's still down. We came close to finding a bottom here, but now you can see they are once again moving apart in terms of where the particular MACD lines are. And so for that reason, it's telling us that this market's got more potential to the downside than it really does to the upside. The other thing that you want to look at, of course, is our Japanese average charts, because that's going to tell us the strength of this current downtrend. When we do that, here's what we notice. We notice a couple of things that are, I believe, critically important. These last 3 trading days have had an absence of any kind of upper wick. What that tells us on a technical basis is that at no time during the trading day did it trade at or above the midpoint of the prior day, because that's where they fix the open, is the midpoint of the prior candle on a daily chart the prior day. Over 3 days, we've seen that. Also, look at the relative body size that you get here. Even this attempt to move to the upside, look at the small bodies and look at the large body size that we're now getting over these last 3 days. And what that tells you is that there's a pretty dynamic strength to the market on the downside. Now, this kind of strength does occur when a market bottoms out also, because you get those final pushes to the lows. You can see that right here. You're getting that. And that's why just looking at the Japanese average charts without taking other things into consideration really isn't the best avenue. You really have to take it all into consideration. So again, that is our strategy that I'd like you to implement. And the reason that I'm putting it out this way is this is not buying something or selling something at the market. Parameters and specific actions have to be met in the market before the trade is implemented. And for that reason, we have to put this trade alert out in this manner. So traders are looking at crude oil. It continues to fall out of bed under tremendous pressure, well below $50 per barrel, trading at 48.69. And traders, lastly, we'll take a look at silver. There is absolutely no doubt in my mind we don't have the same kind of percentage sell-off that we have in silver that we had in gold. Gold is absolutely reacting to the downside in a larger percentage drawdown than silver, which is unusual because typically we get silver leading the way in terms of percentage drawdowns as well as percentage gains on the day because of the fact that there is less volume, less liquidity in the market, and more sensitive to overblown moves, so to speak. Now, that being said, we're back below 16, trading roughly just above 1650, currently 1567. We are still looking at different levels of support. The first one being at around 1510, then of course 14 per ounce. Those are the two levels that we're looking at as our current level of support. My sense is that if silver breaks, if gold breaks, we will see silver break with it. Again, please join us for that live webinar tomorrow. If you have questions on specific models that we're looking at, we'll try to address them then. You can sign up on the front page of thegoldforecast.com. Look forward to seeing you then. This has been Gary Wagner, wishing you as always good trading. We'll talk to you tomorrow during the live webinar. Bye-bye.